Good morning or afternoon, everyone. We'll give it just a minute or two to let people log in, and we will get started. Just give it one more minute or two. All right. Good afternoon, everyone. Welcome. My name is Kerry Peoples. I am the head of capital markets here at Bonaventure, and I am happy and delighted to be joined by our founder and CEO, Dwight Dunton, out of Alexandria, Virginia. Hi, Dwight. How you doing?
Hey, Carrie. Hey, everybody. Forward to chatting over the next 30 minutes.
Awesome, awesome. Well, we're going to kind of creeping into the Bonaventure story a little bit, talk about who Bonaventure is, where we came from, where we are, where we're going. Talk about the Dwight story and his family's story. We'll talk about the multifamily sector. Let's dive into that a little bit about what we buy, where we buy, how we buy it, and what makes multifamily real estate attractive in today's marketplaces in our regions. And we'll talk about, again, our strategy, how we go about and perform for our investors. And then we'll talk about the structure of actually how you can invest with us. Fair enough? We'll go from there.
Sounds like a
Um,
good plan, Carrie.
let's get going here. Okay. So I already talked about the agenda. We're going to move on, who we are. Dwight, why don't you start us off and kind of kick off the story of Bonaventure? We'll go from there.
Sure. Our origin story is really interesting, and what we've done over the last 16 or 26 years is even more exciting. But basically, our family had owned a piece of land that was in the path of progress, zoned for apartments in 1960. We couldn't afford the real estate taxes. So my dad and grandfather found a company like Bonaventure to be our partners. And for 40 years, we collected checks and appreciated and value, did all the things that one would hope real estate does in your portfolio. In 2000, when I launched the company, I bought out our partners and began the process of continuing to build wealth for our family through investing in multifamily. And then we had more families join us for the next deal and the next deal. And here, 26 years later, got almost $3 billion of assets under management, probably have 500 families who have joined in investing with us. And it's all through that lens of long term, tax efficient compounding, build wealth slowly by compounding your way to a large sum of money at the end of the rainbow.
It's great. And this slide gives us a great little snapshot of kind of where we're at today. I just want to point out our balance sheet's just shy of 3 billion of AUM. Now that middle, that um, 590 million of sponsored invested capital, I think is very crucial for the investors and for audience to understand that in this space, and as far as a sponsor goes, that having that much capital invested alongside the investors and across entire portfolios is pretty significant. And so our interests are extremely aligned with our investors. Wouldn't you say, Dwight?
Yeah, I mean, I look at what we do is first and foremost, we're investors that co invest alongside those 500 families. And secondarily, we think of ourselves as a sponsor and asset manager because there is no option for us to lose money because we have the largest amount of money available. So we really are focused on being an investor first. And I think that shows up in how we approach investing with our clients.
It's huge. So just to go to some metrics here, just over 9,000 units, 24% IRR since inception of 2000. a 2.8 equity multiple, and 36 full cycle events. Um, Dwight, why don't you dive into a little bit of slide a little bit and talk about, the different pillars that we basically, this is basically lines are vertically integrated real estate operating platform. So why don't you talk a little bit about that?
Sure. Well, I get sent a lot of deals. I mean, I might get 10 deals a day, and every deal looks amazing in Excel. But the reality is Excel isn't how you make money. It's being able to execute. And what we discovered over the last 25 years is sometimes there wasn't a vendor that could execute the way we needed to. In fact, a lot of people that didn't really care about the outcomes, they just wanted to collect whatever their contract fee was. And so we built the team of people that is responsible for getting the outcome no matter what the curveball that is thrown at your spreadsheet is. And so we have a development business, we have a property management business, we built an internet service provider, which is probably the one I get the most strange looks when I talk about our platforms. But this is one of the most valuable uh, businesses we have to our investors. And really, this was born out of necessity because Cox, Comcast, Verizon provide the same terrible service in your home as they do at our apartment communities. If you look at their financials, they're making a ton of money, and we thought there must be a better way. And we went out and we talked to a lot of internet service providers, and no one did it the way that we thought it needed to be done. So we built that. And the end result is every one of our properties that has become about $10,000 more valuable from the increased NOI. That's $700. Plus, our residents have had an amazing experience. It's really been a win-win, but I think personifies the Bonaventure approach to building platforms and businesses. We do it only out of necessity. It's not my goal to have a bunch of operating businesses, but rather it's my goal to make sure that we get the outcomes that our performers say, no matter what the obstacles are that arise in our way.
Well, I tell you what, all my discussions I have in the marketplace out there with investors, advisors, RIAs, they highlight of my discussions is this internet subway. And all the facial expressions, reactions I get are pretty much excited and interested, and they want to dig in a little bit more. Basically, how we're creating NOIs just besides just increasing rents. And this internet subway story to me is absolutely amazing.
Right. And I think it not only touches on the vertically integrated platform, but really the Bonaventure perspective is how we must be able to grow cash flow, and we have to grow it above and beyond simply what the market hands us. And so this was a huge tool we created to help always be able to grow NOIs, because if you grow cash flow, values follow.
Great. Let's talk about the multifamily market today, Dwight. Why don't you touch on
Absolutely.
base on that?
Yeah, super simple perspective, which is housing policy is broken in our country. Uh, the ability to zone land, get it through entitlements, get permits, et cetera. It just makes it really hard to build housing. And if you look at the business cycle, it oscillates. And so if you overlay those two things, there's always a way to make money in housing. And Bonaventure has become an expert at that. But not only just making money, but ensuring that we keep more of it because we are tax smart. We have done over $1.3 billion worth of tax advantage transactions. We take advantage of the plethora of tools the IRS provides to defer and minimize taxes because it's not how much you make, it's how much you keep. And the last thing is we know that, as I said, the economy cycles, the liquidity cycles, and we need to be able to get through those troughs in the economy. And that's where that fixed rate long term debt comes into play. And that, the liability side of our balance sheet, we really look at as being a strategic asset because it helps us weather the inevitable rough patches in the economy, the storms that come every 5 or 6 years. Seems like they've been coming faster than that recently, though.
I think times is just seems like it's flying by, right? So,
It does.
the besides the internet subway, to me, one of the most highlighting, intriguing stories is our debt structure. Today, we're one of the largest, if not the largest, borrowers of HUD financing. Can you talk a little bit and touch base on HUD financing?
Yeah. So, stepping back a little bit further, the three largest lenders to the multifamily sector are Fannie Mae, Freddie Mac, and HUD. So, we are fortunate that in multifamily housing, our lenders are always open for business because they're backed by the US government. But within that, HUD is slightly different. They are a loan insurer. In a lot of ways, that they do it exactly the same way as they do in the single family market. You have a lender, and then HUD insures that mortgage. That comes with pros and cons. Two sides to that coin. The pro is it's an amazing interest rate. It's fixed for 35 to 40 years. It can provide you a construction loan and perm loan all rolled in one. That's the pro. That's the head side of the coin. The tails is it is a very rules intensive program. And so it takes many months to get through it. However, we feel that the juice is worth the squeeze, that the outcome of having, a mortgage that will fully amortize over the next 35 or 40 years and have a built-in option that if rates go down, you can do a refinance to lower your interest rate. There's just no better outcome. Terrible process, but great outcome.
That's great. Great color. For all of those out there that are unfamiliar with this type of financing. Now, I know you touched on it a little bit, but I'm an advisor, an investor, and I know multifamily has been not it's been in a pretty tough spot to know. So what would you say coming in an investor? Why would I invest in multifamily today?
Well, I would say it's been in a tough spot in overbuilt markets. Uh, if you look, the headlines say multifamilies really had it difficult. The reality is certain markets have had it really difficult. Others have been really great. They weren't overbuilt, and so I think that is the reality of what has occurred over the last several years. Some markets have been crushed by supply. Others have done just fine. But regardless, what I see is supply is the story. Whether you've been in a market that has had very limited supply or an oversupplied market, both of those markets are seeing no deliveries, very limited deliveries. And our research over the last 25 years, the biggest determinant of rent growth isn't how many people live there, or did Google open a branch office? It's what's the supply pipeline. And the supply pipeline is down everywhere. And so even some of those boom markets like Austin, south end of Charlotte, Nashville, they are running out of that supply that's been delivered, and they are likely to get a real rent boom. And so that's really the opportunity set is you're coming into investing in a cyclical low of supply, and that has largely been the biggest determinant of future rent growth is that supply pipeline. And that's a great backdrop to have a tailwind for investing in multifamily.
Well, thank you so much for just painting that picture. And we will further on this conversation as we do these calls on a monthly basis and continue to give updates on basically these strong markets and the opportunities that we're investing in. Speaking of markets, why don't we talk a little bit about the Mid-Atlantic and Southeastern region right now?
Sure. Well, I think this is probably the most economically dynamic part of the country where you've got continued population migration. Certainly, some of the peak population trends have slowed down, but all these states are net adding people. And that is an important fundamental backdrop. And then if you overlay that with not only the market, but then finding that sub market where there's just not supply, you've got a pretty awesome backdrop. So limited construction, continuing rent growth. You see a wide band between Class A and Class C. That creates that headspace to do renovations to drive cash flow. Um, and we also look for those markets where maybe there isn't as much competition with capital, slightly less institutionalized, but strong fundamental. That is the recipe for finding a great opportunity in a great submarket.
That's great because I think a lot of discussions are out there and advisors of why the South, why the Southeast, why these states. And it just paints a clear picture of where we're at. We did talk about the debt a little bit, but the capital stack of the HUD financing, right? Low interest rates, our fixed rate debt, and our term. Is there anything to add there, Dwight?
Um, I think that there's been a lot of sponsors who have made interest rate bets in the form of floating rate loans. And I would just encourage any investor just to ask themselves, would they make a bet on interest rates by going into the commodities market and buying or selling interest rate futures? And if the answer is no, focus on making a great real estate investment and leave your interest rate speculation to a different investment pocket and use fixed rate debt as a way to ensure that you're not taking unnecessary risks.
So long-term fixed rate debt equals a little more stability in the marketplace, and I also with the less volatility with your investment in multifamily or in real estate in
Yeah,
general.
I mean, Kerry, in the last several cycles, when people have been wiped out, they got wiped out because their loan came due or they had an interest rate spike because of rising interest rates. The people that bought those properties because the previous owner got squeezed out, all the values recovered. And but the problem was is that the previous owner didn't see any of that because all the value recovery happened with the new owner. And the fixed rate debt allows you to get through whatever that problem is.
Okay, great. Explains a lot. Thank you. In 2021, September 2021, you launched BMIT. And BMIT stands for Bonaventure Multifamily Income Trust, which is a perpetual REIT. You want to talk about that a little bit?
Absolutely. We had been super successful working with lots of families, but we were doing it in single asset investments. So it was really difficult for people to get liquidity, to get diversification. And at the same time, we saw that, we'd helped several hundred families, but there were tens of thousands of families that we could never reach. And so bringing those two concepts together was we rolled up some of our legacy assets to seed this fund as a way to help our current investors get diversification and liquidity, but also make it a more user friendly manner to bring in outside investors through wealth advisors and broker dealers. And that has really been a magical formula, which was we have a stable portfolio of assets. I think now 23 assets, over $1 billion of gross asset value. And we can allow new investors to come in every month. So we're always open. We don't have to wait for, oh, we're buying a deal in 3 months. And so it gives a great, really flexible entry point for investors to come into BMIT as a way to get started with their real estate investing or to expand it because they say, you know what, I get the macro theme and I'll let Bonaventure do the property picking.
Great. Great. Well, I'm not going to spend too much time diving into the complete different um, investment vehicles, through the BMET and the DSTs and the preferred and what have you. So we are going to, if anyone has any questions or want any further information on that, please reach out, let us know. We're happy to help and happy to send out information and even schedule a call in the near future as well. So again, talking about the two different share classes for BMIT. Again, I'm not going to go in too much detail into this, but if you guys want more information on the different share classes and the opportunities, please let us know and reach out. Okay. We do offer 721, or sorry, DSTs in the marketplace. Let's talk about that a little bit because this is always kind of a hot topic in the marketplace, Dwight, and talk about the DST marketplace out there, the optional 721 into the BMET, and kind of how that can help investors with a tax deferral basis.
Yeah. 1031 exchanges are a simple tool in concept, a complex tool in execution. The DST is just a method to allow individual investors to buy and access institutional quality real estate in a more efficient way. If you're a casual investor and you're not doing this every day like we are, really hard to execute a 1031 exchange. And for some people, that is a great solution. But for others, there's an even better way, which is you do a 1031 through a DST, and then that DST gets upreated or a 721 exchange into BMIT. And what that does through a seamless two-step process is the investor goes from owning their current asset to becoming an investor in a diversified fund. And that is magical for many individuals and families because it gets an institutional quality real estate, institutional sponsorship, diversification, and liquidity options through the quarterly redemption process. So it's a really powerful set of tools for a lot of investors.
Great. And then you guys, I mean, I know there's a lot of questions out there and a lot of, in today's marketplace with the DST market, the 1031 exchange market. And guys, I just want to let you know we're here. This is educational. We're here to help with any specific questions or cases you guys might have. And we're also kind of go above and beyond when it comes to particularly larger cases and kind of do a more of a custom solution for some of our past investors, family offices, and some of our advisors as well. So Dwight, you want to talk about kind of creating a custom solution for some investors?
Absolutely. I know that a lot of clients, they have larger needs, more complex needs, and we help families with larger exchanges accomplish not only the tax deferral, but then we can solve a bunch of other problems about getting liquidity, uh, letting some partners exit, some stay, getting some family members liquidity and optionality to sell shares. And so we really take a blank sheet of paper for those custom solutions, a consultative approach where we work to understand the entire landscape that the family comes in. I literally hung up with a family before this call. And what I said to them is every family is different, but they all rhyme. And that's the experience that we've had is every family situation is totally unique, but the concepts and needs of those families are very similar. So we get to bring that wealth of experience to bear for every family and help come up with a solution that's a perfect fit. And at a minimum, what it helps the wealth advisor do is add value to that relationship. Even if Bonaventure it can't provide a solution, or maybe the client actually doesn't want to do anything, it just bringing us to the conversation helps increase the value of that relationship exponentially.
That's great. I know there's a handful of cases that I'm dealing with not only advisors but larger firms out there that don't necessarily have these type of solutions and are talking with Dwight and Bonaventure to help them through this process, to help them add value to their larger investors and their family offices. So it's a true testament of kind of the above and beyond the extra step and the little white glove service that we kind of offer in the marketplace that kind of sets us apart. So thank you, Dwight.
Yep.
Different share classes, the core plus, value add. These are some of our assets that are in our current portfolio. Dwight, you just want to touch on the kind of asset classes, and then these markets are obviously in Virginia and Georgia and type of our region. So the core plus, value add type strategies.
Yeah. So I think that this is kind of a macro overview of different ways of investing. Core, there's newer assets that maybe don't have as many levers to pull to grow cash flow, but at the same time, they're very new, so they don't have risk for capital requirements in terms of replacing roofs and so on. And we want to find those in steady eddy markets. A core plus is an asset that still fairly new, but there might be small little improvements you can make to drive NOI through maybe changing out light fixtures or changing out an appliance package and getting a pretty nice return. And then there's a value add where it's an older property, but you can do an entire kitchen and bathroom replacement. You might be able to do a new clubhouse renovation, and where you can get significant returns on invested capital, but also deploy a considerable amount of capital. And so, for instance, take a value add opportunity. you might have a 15 per $1,000 a unit budget and you earn a 20% return on that. It's roughly $250 a month of increased rent. Whereas a core plus, you might spend $2,500 and get a 20% return. The returns on invested capital are similar, but when you blend that with the purchase price, the value add opportunity should result in a significantly higher IRR over the hold period.
Great. Thank you for that, for that breakdown. I am going to move on here 1 second, and before we're gonna wrap this up and head into Q&I, this is kind of our different vehicles. We touched upon this a little bit, but let's switch it over to some Q&A, and then we'll wrap this up and can keep this around the 30 minutes or so range. So let me get some questions here. Question number one: what structurally differentiates Bonaventure's platform, Dwight?
Yeah, I would say two things. One, we're the vertically integrated company. Like we own the most important tools to ensure that we achieve the business outcome. And two, we do it in a way that is user friendly, investor centric, which means that fixed rate long term debt, those different vehicles such as the NAV REIT or the single asset investment, the DST, it's all about making it accessible for those investors.
That's great. Thank you for that. Question number two: how should firms think about the different access points to the Bonaventure platform from a suitability and supervisory perspective?
Well, maybe that's a question for you, Kerry. I'm the real estate investor. You're the capital markets expert. I'll chime in here, and I'd love to get your thoughts on that. I think we offer these. They're all Reg D offerings, so they're private. So that obviously means that accredited investors. So, and then you also have to think about it from a portfolio perspective in terms of where this fits in their overarching need. For me, I think that this needs to be money that the investor does not need. This is part of that compounding bucket. And if they need access to liquidity, while there is limited liquidity in certain of our programs, I would encourage those investors and their advisors to think about other buckets that they could pull on if they need immediate liquidity.
Yeah, I'm going to add on to that and basically talk about who maybe it's not for. The accreditation standard is in place for a reason, but if it's someone who's just meets that accreditation standard and is basically needs that check on a monthly basis, which will be there but is waiting for the mail, and that maybe might not be as suitable for someone who has not necessarily liquidity needs, or it is basically a little more has on the wealth stack side, that does not just barely meets that accreditation needs. So I will chime in on that front for the suitability, and I just think that gives it a little more breathing room for the advisors and the investors to invest in a vehicle as we offer through BMIT or DST platform. Okay, that being said, why is the 721 exchange a core capability for Bonaventure rather than peripheral offerings?
Yeah, it's really simple. For the last 25 years, we've done $1.3 billion worth of exchanges out of necessity. I didn't want to give our partner, Uncle Sam, anything more than the minimum. And so we developed this capability and we want to pay it forward. Like we figured this out through the School of Hard Knocks. And that 721 exchange is not a very common transaction. There's very few people who have any experience doing it, much less even know about it. And we find that we're able to get access to assets via the 721 exchange that wouldn't necessarily come to market, or for that investor who's that 1031 to 721 client, like they want somebody who's done this many, many times versus, hey, sure, I'll do anything for $1. We've done this for hundreds of millions of dollars of assets. We're experts at it, and we are willing to put our name behind our delivery of those promises and commitments.
Dwight, I want to thank you very much. We're right at 30 minutes. I want to keep it right at 30 minutes to be respectful of everyone's time. So thank you everyone for joining us today. Reach out to us directly with any other questions or comments or anything you want to reach out to us to schedule a call or any additional information. And Dwight, have a great rest of your day and have
Yeah.
a great weekend. And thank you
Thanks,
so
Kerry.
much. Thank you.
Thank you, everyone.